All right. Seems like we are live here. I just want to see if the correct. Let me see here. I just want to see if the correct microphone and cameras are being used. I don't see anything on my side. Let me see here. Boom. Edit. Broadcast visibility. Okay. 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 All right. So let's see if we can make this happen here. All right, so I'm just trying to make sure some things are working right. This is my first time using YouTube Studio, so hopefully you guys can all hear me. This is my first time using YouTube. Okay, so I want to cover a few things here. First thing I want to do is kind of do a portfolio review. Just kind of go through what's happened, what we're doing, how we're preparing ourselves for pretty much this year. More importantly, talk about the SoFi rolls, which I did a post on, and that's pretty much it. Let's go ahead and jump in. So, first thing I want to do is we're going to go ahead and do a quick kind of portfolio review, see what we're doing, what the return expectations are. So, on the 10th, we have so that's tomorrow. We have about four options that are expiring, right? Two of which are poor man cover calls, and two of which are share. So if we go to Celsius, right? Celsius has been one of those stocks that it's gone up. It had a fabulous rise to 70, $80, $90, and then it came back down to 28, 25. And so because I wasn't exactly sure what was going on with it, what I decided to do was really just buy a $25 call, right? I would feel comfortable buying them at that amount. It seems like the true or the fair market value of Celsius has been hovering around 27 to $20. And so I went ahead and bought that option a while ago. I think it was 2 or 3 months ago. Let's see here. I bought it in January, March. Pretty decent amount of money. It's still worth 440, even though it's expiring in a week. And the idea with these poor man cover calls is the idea is that you're controlling 100 shares for a lot less of the cost, right? So instead of me having to spend $2,500, I'm essentially controlling those 100 shares for just the mere cost of $600. And so because the premiums that you're bringing in are the same, the ROI per covered call is a lot more than if you actually own the shares, right? Because it's whatever you bring in with the covered call divided by the 660 as opposed to the 2,500. And so that's essentially what I've been doing with Celsius. Right now I have a 28 call, which is really close. It's in the money right now, but it's really close to being out of the money. I had sold that for a $60 premium, and so what I will probably do is I'll probably either roll it out maybe 1 week and keep it at 28, depending on how the week looks, and then next week I'll either take a decision of either rolling out my long, just exercising it and buying the shares. So if I go to my tracker here, right? So this is really the important part and why I'm such a sucker for recording and tracking your trades, because it allows you to make the right decisions and it allows you to see if it's worth actually or just cutting your loss, or possibly at a profit, depending on how much income we brought in with the covered calls. So, okay. So what we show here with Celsius is very simple, and I hope you guys can see it on your screen. You may have to put the quality up a little higher, but so the purple are basically options that I bought, right? So this is the option that we bought for $651. The cream colored ones are put sold. So technically, those don't count towards our campaign, even though if you count them, you can. But if you want to look at the Poor Man's Covered Call campaign strictly on its merits, then you should only really evaluate it based on the covered calls. So if we were to do that, that means that so if I was to look at where we're at right now, we brought in, right, if we're just looking at covered calls though, we're looking at and this is assuming this one expires worthless. We're looking at about $100. Tremendous amount of success. Now, what does that mean? It means that we've lowered our purchase price for these $25 shares to by about $100, right? So that means that in reality it's $550. And the right way to look at it is if you look at 551 and you divide 551 by 100, you're essentially cents per share. So that's how much we paid per share just to control them, right? So if you really want to look at what your cost basis is, if we were to buy them at $25, right, and we add what we pay for them, which is $551, just right now it's trading at $28.90. So it's not necessarily a home run, and it's not even a profit really at this point. So what other options do we have? The other option that we have is we just let it get called away, right? We just let it we sell pretty much the long call, right? Celsius is going to close at $28, right? So what I would do, and I would probably, maybe we go up to 29, assuming that it closes at 29. So we get a $7 credit. And then we're going to have $120 of credit, right? So we're going to assume it sells at $29, right? Now we have $129 of credit that would be credited to us once it gets called away. So 121 plus the 8 on the roll, right? So times 100, you're looking at 2,900, 121 and 8, right? So we're going to add all of that up. It's 3,029. But remember, we really only control the shares from 25. So it's really from 25 to 2,900, which is 5, 6, 7, 8, 9. It's really $400 that we're going to be making, right, on that difference. Share appreciations, right? 121 from the credits, 8 from the roll, 98 from the previous credits that we got, and we're going to be at a 627. right? Now we paid 651. So it's still going to be about a $20 loss. So essentially what happened is we want to squeeze out enough premium on Celsius to make the cost that we paid for those shares worth it. And that also Celsius didn't really go anywhere. You know, it's only gone up $4 in the past 4 or 5 months when we've had a tremendous bull rally. It's really on your end. Do you want to buy the Celsius shares at 25? You know, with really $100, nothing crazy. You know, $5 to $30. I mean, it's still 30. You're still basically over. Or do you wait and find a better entry point if you still like Celsius? I personally drink Celsius. I really like it, so I'm pretty bullish. But I don't necessarily think that $30 or more expensive than what we bought it for is, so and truthfully, I'm looking at the puts that we sold, and we made a lot more money on the puts than we did on the calls. We just continue selling puts and seeing what happens. So more than likely, probably what I'll do, I'll probably sell the call. I'll roll it out one more week, might as well. Depending on this expires worthless, then more than likely I'll just go ahead and sell the call as well, right? Have that week of juice still in it. I'll probably wait 30 days. If the loss is significant, if it's not significant, then the wash rule is not even worth it. And then I'll wait for Celsius to pull back. I should have probably bought it. We bought this October 8th, and if we look at Celsius where it was October 8th, but you see that's the important part of having this option, right? So essentially we really only lost about $20 if we decide to sell it. But we only really had $600 tied up as opposed to 2,000. So the question is, were you efficient with those other $2,500? And the idea should be that because you're required less capital, that you did something a little the rest of the money. So if we go to October 10th, you see Celsius was really at $35 and it went down to 28. So that's also part of the reason why it hasn't performed well, right? Because the idea is that you generate that income, but hopefully the stock continues to go up and therefore the contract holds its weight or continues to go up. It seems like Robinhood has been a net past year. People have liked the price. Hedge funds have really loaded up. So, look, it may be worthwhile to at this amount, and then just continue wheeling them. Maybe that is what we'll do. It all just depends on where our capital is. Ray Dalio here sold about 25% of their shares. I don't blame them. So, anyways, that is where we stand with Celsius. So this is another one that we're doing the same thing on is Target. Target got earnings, and I think Target is one of the main retailers, and they have a lot of success competing with Amazon, and I suspected they were going to do pretty well during the holiday season, which we'll soon know at the Q1 earnings. I think we're looking at, let's see what we're looking. It's a decent PE ratio. $14 is pretty decent for a retailer. We see here that Robinhood retail has pretty much been selling a lot of their positions, while the hedge funds have had a net sell as well. It seems like January they loaded up a little bit, or I'm sorry, that's Q3. So people aren't very bullish, but this is bullish, right? The insiders Q4, they bought a lot at 150, 155. Generally a good sign. So what did we do here? I bought two $125 calls, right? So I buy them a bit deep in the money. Just it helps with the decay and overall loss of value. You do want to buy some. Do want to buy a bit in the money, and you want to buy them at least 5 6 months out of the money, and then you ideally want to sell them with about 2 to 3 months left on it, which is when theta starts to accelerate. So we bought two of them at 2040, right? So we paid $2,000 to control 200 shares of Target. Right now they're worth about 1960. So they haven't really lost a lot of value. I think we bought them well. We bought them in December 11th, which is when Target was all the way in, let's see, December 11th. So it was at 135. It's at 138. And at one point it went down to 120. So I saw the positive trend. I said, you know what? I think it definitely reached its bottom. Let's go ahead and dive in. So we bought two 125s and then we've been wheeling it. I think I just rolled I just rolled this 135 to 140. But essentially, if we go to Target, and I think I have it in my side quests here because it's not a full position yet. I should make it one though. You can see it here, TGT. I'm gonna highlight it where we have a $4,000 investment. We sold two calls for $120 profit in December. Sold another two calls, one for 200 at 135. I just rolled, and if you get assigned the long call and you lose all the time that you also buy. So you have to be very careful of that, right? So we bought back the 135 for 323, and that was on the 323 we bought it for, right? Which means that we took a $124 loss on that covered call, but then we go ahead and turn around and buy ourselves more share appreciation, which we can because this expires in June. So I have plenty of time to roll. And so I rolled it from the ones expiring tomorrow to them expiring in about 30 days, February 7th, because it's appreciation, right? And I always, especially when I'm doing the poor man's covered call, I always like to roll up for a credit. And this was soonest amount of time that I could roll up and out. So we got 328 for the 2 7s. 328. So should this close out the money, that's a $205 credit. If by February it closes under 140, we already blocked in a $325 profit and we option. So I think with Target, we're just going to continue doing the poor man's covered call and really try to squeeze out profits on that one. TSLL has just been a huge money maker. You know, it's very volatile, but the premiums are very. And overall, I like Tesla, and I remain extremely bullish on it. So I don't mind that it's 2x leveraged. Sorry about that. I caught a cold. I just got back from Iceland, which was incredible. Our TSLL position, we're in a pretty good spot. We have about 1,300 shares at about $17. So right now it's at 25. So we have a healthy premium, a healthy profit And pretty much what we've been doing, you can see here the total return, $5,000, is just selling calls and puts. I mean, that's really it. Just keeping it simple. Just like TJ likes to mention, keep it simple. Not to get too complicated with these crazy strategies. It really is just I've detached myself from the when it goes to either one, I'm just readjusting my shares and my calls is next. And that's how you should really be looking at it. So to me, do I and I'm not particularly fond that it's gone to these 26s are printing, these 31s are printing, these 30s are printing, and these 19s are also printing in a way, even though they're underwater. It allows me to close them out for cheaper if I want to, or it's a pretty decent hedge if it continues to go lower. So these $30 calls, for example, which I had to roll out because they were pretty underwater, I have a pretty decent decides to not do much until that time. That's good. I mean, look, we've got 5 contracts that still have that's a good almost $4,000 that we get to keep. We've already made about 1,800 on it. So that's the beautiful thing about it. Now, what I do like to do is I like to really sandwich my trades, right? So it's called pretty much you're guaranteeing a win, right? That's really what this is about. What's going to happen tomorrow, right? Because right now, 71. So if this price stays for tomorrow, I essentially keep all the premium on this 2670 call, right? Which is a pretty decent premium. Let's see what premium we got for it. We got $250 for this premium, right? So $250 I get to keep if it stays at 2571. And then technically this 2570 would also expire worthless, but worst case scenario, I roll it down. I roll it out. And put we collected $75. So we could close it for a 15% profit and then just wait. But truthfully, I'd probably just roll it out. Why wouldn't I? So that's pretty much what I've done with a lot of these. I have a pretty hefty position here with these $20 puts that expire next week. I'm not necessarily concerned. And I'm already at 80% of profit on these. So if I was concerned, I could just technically close these out, but I'm not. So TSLL has been a pretty just, run the campaign on it, run the wheel on it, and really sand, and with this particular trade here, for example, where I have these 1970 calls, right, which they're pretty deep in the money. How can I make sure that I also profit from having this here? Well, I sold some 1970 puts for that same amount. And what did I do? I collected $420 of credit, right? So 425 is 2,100, and it's 1970 or times 5 is 9,850. So 9,850, and we collected 420 times 5 gives us a 2.13% return, right? So I'm essentially squeezing 2% return in what is that? In 6 months for a very low risk trade. We're at 25. And if it does happen, if I do get to that amount, then I'll just roll it down. But guess what? I make a lot of money on these 1970 calls. So it's not the end of the world. Got the here. And these would collect another $5,000 here. So it's really a win-win on either side. And that's how I like to position these trades. So if we continue going down our list here, we've got Target, Celsius. Now, Crocs is another one that we're doing our covered campaign, our poor man's covered call campaign. And Crocs has been a bit more successful because gone up and actually it was trading at around 111, 112. So now that it's out of the money, it actually benefits us. Probably close that out and then sell one that's a little bit more out of the money. So we're at 109, and you can see that it had gone all the way up to, we were at 114, 115. I think Crocs is just a staple. It's just become one of those firms that it's become so integrated into the hospitality industry, into young kids. I mean, it's just got a huge a lot of the pushback it's gotten was from they had to basically depreciate their Hey Dude brand. It didn't go so well, but it is what it is. I don't think it's detrimental. You can see here that retail just completely dumped it, and then you see there was a net buy starting this year. Same thing with the hedge funds. You see hedge funds were pretty, they were selling a lot of it. Q1 2020 started to buy up again, Q2 started to buy up again, Q3. So you're starting to see that it reached the bottom, which is what you like to see. Now with Crocs, I bought a 105 call, which look, I really like that entry point. My goal is to generate enough income to where at least the premium is paid for, so that if I desist, it's at the 105, not at the 105 plus what I paid for the call, just 105. And what did I pay for it? So $1,000 divided by 100, that's about $10 per share. So I basically paid about 115 for this call per share. But again, I have until right now. This particular call is up. It's up about $200. So I could sell it and just make a profit and call it a day. But I really like Crocs. And so right now I'm just focused on generating that income. If we go to, I don't know if I think it's still a side quest here, if I'm not mistaken. So, and by the way, I had two puts sold on Crocs that we generated, $730 from. And so I'll probably do that again. I'll probably open up that's not bad. That's not a bad idea, actually. I'm going to open up another put. I had sold one at 105 that I had to roll for a $400 loss to. So if that's out of the money, that's another $200 that we're going to profit considering that loss. So what I'll probably do is I'll probably sell a one for 117, which I can always roll down, but ideally it's gonna make sure that we profit this 598, and then we'll be on our way to profiting pretty much off this basis. On with it, I like the stock. Hims is one that I would like to open up a larger position in, but I do think that it's very volatile, and it's very volatile to news, to medical news, and a lot of these rules change or they try to really make their stamp on it. So, if we look at where we're at right now with Hims, I had a phenomenal entry point with it. I think earlier this year they went down all the way to, I think it was like 15 or 6, yeah, 1657 is when I bought them, which is an incredible entry point. I like the stock. It's very volatile. Premiums are nice. So right now I have 10 $25 puts that I sold. Right now it's at 25. So yeah, this one is, we'll see what happens, but I'm not particularly concerned about it. It's still at a profit because we sold them in November. But we've just been riding it. I mean, it was down 8%. So considering it went down 8% and you're still at a profit, that's just a testament to the strategy. $5 call that's expiring, hopefully not have to roll either way, right? Either it's the 25 or either I win on the puts or I have to roll out the call. And even the call is at a profit, you know? So again, Hims is just one of those that I'd like it if it got under 20. I think under 20, it's a screaming buy. You know, you look at the year to date, and it seems like it just goes through its peaks and valleys pretty routinely, all the way to 22, but then it went all the way back down to 13, and then here it went all the way back up, which is a pretty good trend. I mean, it's doing higher peaks, right? And it's their model is working. So at Robinhood, I mean, retail has been pretty much a net buyer. Hedge funds have pretty much been net sellers Q2 when it was at 20 bucks, so they pretty much missed the rise there to 30. And then we had a 50-50 on Q4. Insiders have been pretty balanced, you know, which is always good to see. It's when it's only one-sided. Accumulation via grant, automatic sell. Some people just have automatic sells. It's not a bad position to be in. I am looking to increase my position in that stock though. So Riot has been one that, you know, I usually try to stay away from miners, and I'll show you quickly. I'm officially out of CleanSpark. I don't necessarily like CleanSpark. I've had a very interesting journey with CleanSpark. I first bought my 700 shares at $17. I think right now it's trading at like 10. And so through the wheel strategy, we were able to generate a win and actually squeeze out a 12.5% profit 6 months that we owned it. So you can see here that my basis was pretty, you know, I'd say it was 16-ish was my basis. And then I just started unloading them with my last ones December 31st to loss. But on the contrary, we were able to generate about 5 grand in premiums. So if you look at my shares, which they cost me 13,000 this year, my shares cost me 13,165. I ended up selling them for a total of 9,800. So I took a loss of 3 grand on my shares, but I generated about 5 grand on income of options, which leaves me with about $1,600 of net profit. So if I was to divide this 16, me out to about a 12.5%. So look, a win is a win. This isn't the ideal scenario, but it just shows you the power of option selling and how you can manufacture that win. And that's what we did here. So back to Riot. Riot to me has been, just through what I've learned and through highlighting their operation, to me, it's one of the best ran companies that mine Bitcoin and cryptocurrencies. And so because of that, in the position that I have a pretty decent cost basis. I've got $10.36 cost basis. I've got 400 shares. So pretty much just the same routine thing. You know, I've got 3 calls. So then I've got 5 $12 puts, a little bit more on the put side than on the call side, which is fine. And then I've got one 1150 put. So again, just positioning ourselves to profit either way. So Intuit was our largest poor man cover call campaign, which a total purchase worth of options. We ended up closing that for about a 20 total campaign. So if we just look at poor man's covered call, so just options bought, we're looking at a 28%. But if I look at puts sold as well, which speaks to how it can juice up your premiums, we're looking at about a 50%. So a total of about $13,000 from 8 October. So decent, pretty decent. This is actually, I would consider this a success with Intuit. We have a total of about $6,000 that we banked. We have 400 shares here. Some of the formulas are not updated. Which we go like this, boom, boom, boom. And then we go here to here. So we have about a 1036 cost basis, which is actually exactly what it shows on Robinhood. And so here it tells me 1036, we have 400. So we spent a total of 4,144. We've done $6,000 of profit to date on those 400 shares. So essentially these shares are free for us. These shares are at a zero basis already, zero cost basis. And you can see that a lot of my money generated on puts. I basically rode Riot all the way up to 12 just by selling puts. Would I have made more money on share appreciation? Perhaps, but it is what it is. A lot of puts open. I believe these $9 puts I closed out, if I'm not mistaken. I have to update a few of these trades, but essentially, Riot has been a phenomenal moneymaker. Phenomenal. What else? Let's go through these quickly. So we did Hims, Crocs, Riot. Let's go to Rocket Lab real quick. Rocket Lab is one of those companies that I think is pretty much the only public option. Give me 1 second. I'm going to get a tissue here. So Rocket Lab is pretty much one of those public companies that's fully advantage of the doors that SpaceX is opening. And they're focused more on a smaller payload launch clients. And so I think there's a lot of money to be made. Again, I've got a really good average cost here, about $16. They're about a 27, so we're almost at a double. Got next week, we've got a $28.50 call expiring, which is in a great position. We've got $32 calls expiring. We've got a $31 call expiring. These are all in great shape. We have a $28.50 put to sandwich this one, which worst case scenario, we roll down. And then we have $20 calls, which I got caught underwater on that I've rolled out to April, which I also sold puts on. So we're in pretty good shape here. We're in pretty good shape, and we're just going to let these run. Ideally, I'd like to get this position up to 1,000, so buy about 400 more shares. 27, I think, is already a bit expensive, especially if you look at the 1-year chart. Look at this chart, so I don't necessarily want to buy. I pretty much bought at its previous height. See what happens. We'll see what happens, but I would ideally like to get it under 20 as well, if I could. But again, I'm not forcing anything. I'm just reacting. And you just have to have clear what you react to. So when it happens, you can strike. So we look at the Rocket Lab, and we have pretty much. I bought these calls, $10 calls, that they show a $450 loss, but it's because I executed them. I actually bought them at $10. So that's why, and I'm gonna need to maybe clarify a bit this to look at calls sold, because when you look at the calls bought, while some did generate a profit, some didn't. $7 loss. I mean, that's wild to me. But long story short, we're sitting very, very pretty with these shares. It says our adjusted basis is a bit higher here. Let's go ahead and do this then. What I'm going to do is I'm going to exclude the loss. This big loss is just from a roll. I rolled it from $15 to $20. So this is going to just show a loss on here until I get above water, which is fine. So we'll go ahead and leave that. Rocket Lab, SoFi, TSL. Okay, so SoFi, right? So part of what I wanted to talk to everybody here about was SoFi's role, right? The $12 call. Essentially what we did is we rolled them from $7 to 12, huge share appreciation. And essentially what you're doing is, even though you're rolling these for a debit, and so what you're doing is transaction. That's really what it is. It's a transaction, it's a trade. And it's a trade that you have to have the math clear on for you to feel comfortable doing it. Because if you don't, then you're going to ask yourself, why am I paying $1,000 to roll this? Am I going to get a return on this money? And so that's what this math is really about. And that's what the math that I wanted to sit down and do, right? So here I had rolling out a month, or sorry, 3 months. The reason I chose the 3 months is just because usually premiums are a bit higher on the shorter term. And with the 3 months, I feel like theta is on my side because of how it accelerates as you get into those 3 months. If a year out, there's going to be a period where that theta is going to be very, very slow. And so that's what I wanted to avoid. But let's look at the math, right? So here we're looking at my $7 SoFi calls, right? So essentially I had lost out on, and this was at this point, it was trading at share price right here, 15. So I essentially missed out on a double by selling this call. Now, emotionally, it's irrelevant to me because it's a give or take, right? You have to ask yourself, what I had sold SoFi when it got to 8 or 9, one of the things that options does is that it forces you in a way to stay with the stock, right? So you have to have your conviction very clear with it. And number two, SoFi ran up selling calls and puts as it went from 5 to 6 to 8, 9 for a very long time. So I'm not necessarily upset, and I'll tell you why too, because it puts me in a position where I am sort of sheltered from the volatility of SoFi as I chip away at the gains that I forgave essentially by selling those calls. So let's look at the math, right? The way I looked at this is if more, and I'm just going to let them give me my money and I'm going to go do something else with my money. $700 payment from the $7 calls. And again, this is not taking into account what I paid for the shares. Is we're looking at it from this point forward, right? To me, it does not matter what my basis is. The calculation. That's what would be my profit from that point to here. I'm trying to see is what would be my profit from now until I roll it out and see if it's worth it, right? So I would have kept the 156 that I had only received as a credit, and I would have gone $856. So come January 17th, if I would do nothing, the system would have given me $856 per contract, and I would have had that cash in my account to do whatever I wanted to do with it after, right? To find other opportunities. So instead of trying to go find other opportunities, I said to myself, well, what happens if I recommit capital, or I recommit that 856 as if it was a new trade to just simply rolling it up, right? Because I've essentially sheltered myself from volatility, especially if I'm going to roll only to $12. I have basically from 13 to 14 to 15 as a cushion if SoFi decides to go down. So what happens? I said, you know what? Let me recommit my capital, and I'm going to sell it for $12 March 21st. And what would that look like if I did that? So if I was to sell them in March, here's what would happen. So here's what I'm showing, right? I'm showing what would it look like on the credit side? Like what would I have to pay? So you have $783 that the contract's worth right now, right? And the $12 contract is worth 360. So that means that I would have to pay the difference of a $423. So I would have to pay $423 today, right? So I'm out $423. But the shares are going to appreciate from $7 to $12. So that's a $5 difference times 100. I'm getting 5 of share appreciation March 21st, right? Because that's when you would decide to sell them, right? So 500 that I'm getting in share appreciation, but the 423 that I have to pay now, I'm essentially making $77 per contract, right? So I've got 5 contracts here, so I'm making, $385. Great. That's $77 profit on that 856, right? Because again, I'm this is my opportunity cost here. This is what I would have had to invest had I not recommitted, right? So if I had $856, where can I place that money to get that $77 from March? That $77 is a 9% return, right? So a 9% return, where can I find a 9% return in 3 months? And that's really the question that you need to be asking yourself. Is it for me to recommit to a stock that I've been tracking for months that I know is still undervalued, still has growth, and then when March comes along, March 21st, I can decide yet again to just sell them for this $12 and spit out whatever be 856 plus 77. So that's, I think, and I like to think of it that way. I think we get carried in our portfolios in chasing these 30, 40, 50% returns in a year, in a month, in 3 months. And we forget that there's risk to all that, right? And I think part of your portfolio should be focused on those types of gains, but I feel like part of your portfolio should also be in a safe position where you're slowly chipping away at growth appreciation, and in a way, quote unquote, you're guaranteeing yourself a 9%. I like to think it's a good position to be in. It's a decent return, very decent return to be in, and I really don't see an issue with it. So that's why I decided to roll it out. Now, if you were to look at the same $12, more money for your time, right? So the share appreciation $100. Um, your cash outlay is half of it, 230, because that other amount, right? The other amount that you're paying on shorter term is getting that money for your time, right? So even if I was to do this $12 call, you're looking at a 32% return. So your money is committed for a longer time, right? But the exchange there is that it requires less of you. So again, oh, I'm getting feedback here that it's not the best.